Stock market investing. Understanding basics, strategies, and evaluation. Welcome to our channel, where we unravel the intricacies of stock market investing, guiding you towards informed decisions for financial growth. Investing in the stock market can be a powerful way to build wealth over time, but it requires a solid understanding of the basics, various investment strategies, and how to evaluate individual stocks and sectors. In this comprehensive guide, we'll delve into each of these aspects to equip you with the knowledge needed to navigate the world of stock market investing. Before we begin, make sure to smash that like button and hit the subscribe for more exciting content. Understanding stock market basics. What is a stock? A stock represents ownership in a company. When you buy a share of a company's stock, you become a partial owner and have the potential to benefit from the company's profits and growth. Navigating the stock market begins with comprehending its fundamental principles. First, stocks represent partial ownership in companies tradable on stock exchanges like NYSE and NASDAQ. Ownership and profit. Purchasing stocks means owning a portion of the company, entitling you to a share of profits and losses. Market exchanges. Stocks are traded on exchanges where buyers and sellers meet to facilitate transactions. Market capitalization. A company's total value is market capitalization, calculated by multiplying its stock price by shares outstanding. Price-to-earnings ratio. This ratio compares stock price with earnings per share (EPS), indicating how much investors pay for earnings. Volatility. The market can exhibit rapid price fluctuations due to various factors. Understanding volatility helps manage investment risk. Research. Investigate companies, their financials, competitive landscape, and industry trends through resources like financial statements, annual reports, and news. Long-term perspective. Recognize that stock investing is often a long-term commitment, capitalizing on compounding gains. Diversification. Spread investments across industries and sectors to mitigate risk. Investment goals. Define clear objectives, whether capital appreciation, dividend income, or a mix of both. Risk assessment. Understand market risks, economic trends, and company-specific risks to make informed choices. Professional guidance. Consider consulting financial advisors to align strategies with goals. Patience and education. Investing is a continuous learning process. Stay updated on market trends, regulations, and economic developments. Understanding these basics lays a strong foundation for confident decision-making in the complex world of stock market investing. Different investment strategies. Investors employ various strategies to achieve their financial goals in the stock market. Understanding these strategies is crucial for tailoring your approach to your risk tolerance, time horizon, and objectives. Long-term investing. This strategy involves buying and holding stocks for extended periods, capitalizing on compounding. It aims to benefit from a company's growth potential over time and can be less impacted by short-term market fluctuations. Value investing. Value investors seek stocks trading below their intrinsic value, based on factors like price-to-earnings ratios or book value. They believe the market has undervalued these stocks and expects their prices to rise as their true value is recognized. Growth investing. Growth investors focus on companies with strong potential for above-average growth. They are willing to invest in stocks with higher valuations, anticipating that their earnings will increase rapidly in the future. Dividend investing. Dividend-focused investors prioritize stocks of companies that distribute a portion of their earnings as dividends. These stocks can provide regular income, making them appealing to income-seeking investors. Index investing. This strategy involves investing in market index funds or exchange-traded funds, ETFs, that track a specific index, such as the S&P 500. It offers instant diversification and can be cost-effective due to lower management fees. Income investing. Similar to dividend investing, income investors seek stocks, bonds, or other assets that generate consistent income, helping to meet their financial needs. Contrarian investing. Contrarian investors go against prevailing market sentiment. They buy stocks that are out of favor, hoping for a rebound when sentiment shifts. Technical analysis. Technical analysts study stock price patterns and trends using charts and indicators. They believe historical price data can predict future price movements. Day trading. Day traders buy and sell stocks within a single trading day, aiming to profit from short-term price fluctuations. This strategy requires quick decision-making and risk management. Swing trading. Swing traders hold stocks for several days to weeks, aiming to capitalize on short to medium-term price movements. Options trading. Options provide investors with the right, but not the obligation, to buy or sell a stock at a predetermined price within a specific time frame. This strategy can be used for hedging or speculation. Passive versus active management. Passive investors rely on index funds and ETFs, while active investors make individual stock selections based on research and analysis. Choosing the right strategy depends on your financial goals, risk tolerance, time commitment, and market outlook. It's important to continually educate yourself and adapt your strategy as market conditions change. Evaluating individual stocks and sectors. Fundamental analysis. This involves assessing a company's financial statements, earnings growth, competitive advantage, management team, and industry trends to determine its potential for success. Technical analysis. Technical analysts study price charts and patterns to predict future price movements. They believe that historical price data can provide insights into future trends. Industry and sector analysis. Understanding broader industry and sector trends is essential. Factors such as technological advancements, regulatory changes, and consumer behavior can impact entire sectors. Risk assessment. Evaluating a stock's risk involves considering factors like market risk, company-specific risk, and macroeconomic conditions. Diversification can help mitigate risk. Research and due diligence. Thorough research is crucial before investing. Read financial news, company reports, and analyst opinions to make informed decisions. Long-term prospects. Consider a company's competitive position, growth potential, and ability to adapt to changing market conditions. Sustainable competitive advantages, or moats, can contribute to long-term success. In conclusion, stock market investing is a complex endeavor that requires continuous learning and adaptation. Understanding the basics, selecting appropriate investment strategies, and conducting thorough evaluations of stocks and sectors are essential steps for successful investing. Keep in mind that all investments carry risks, and seeking advice from financial professionals can help you make well-informed decisions aligned with your financial goals and risk tolerance. If our videos prove valuable to you, be sure to express your support by sharing, subscribing, and giving the like button a solid click to help our channel grow.